It's time now for the Personal Finance Corner, and let's then take it across straight to Fee D'Souza, who joins in from the Personal Finance Desk. Fee.
Thanks, Sandeep. Well, it's very interesting. We've heard again from the RBI, and they've announced details of the inflation-indexed National Savings Securities. It's being called the IINSS so far. This is basically what we were calling inflation-indexed bonds up until now. Now, we hear from the RBI that the interest rate is likely to be 1.5%, and the principal amount, which will keep increasing every month in step with inflation. So it sounds really interesting. I want to bring in Dhirendra Kumar because he's been such a sharp critic of these bonds in their original form. Dhirendra, the changes that you've seen so far happen with the inflation index bonds. Are you happy with this new version?
Yes, it is much better for the individual investor. What was initially planned was the reference will be wholesale price index, which was not a good reference. Then protecting your capital, which is which is happening in a far more efficient way right now in the revised structure, is very impressive. I think this will be, and the way it has all been planned, looks like it will provide any investor, any retiree, an income. At the same time, it will be able to protect your capital, which I think is not possible with any long-term fixed income investments available in the country.
Well, Dhirendra, will the interest earned on these bonds be treated as capital gains, or will they be treated as income? Do you know what sort of an advantage we will have in terms of taxation on these bonds?
No, the interest will, in the revised structure, the interest will not be treated as capital gains. In fact, what they have come up in the structure is that your capital is appreciating, your principal appreciates, and the income will be treated as, the interest will be treated as income. So in that sense, there is no revised definition of interest as income or capital gains. Your capital getting revised and that appreciating. That will be helpful in protecting your capital, and you will be able to derive your income, which will be taxable. So in that sense, there is no redefinition of the income in the form of an interest or any such thing, and because interest income will be taxable, and I don't think it can combat with the income tax laws.
But if we look through the RBI circular very carefully, it suggests that if inflation remains the way it has been this year, then a bond like this will generate returns of 11 or 12%. That seems actually a little too good to be true right now. As investors and as an analyst, do you expect some sort of catch to be announced somewhere, maybe some sort of new taxation treatment going down the line before it's implemented?
Yes, I think it is looking to be too good to be true. And in a country where government is looking for every opportunity to tax, or unlikely to leave an opportunity, an avenue where where it is taxing, leaves that on the table. So that is something which can't be ruled out, a surprise from the income tax.